Welcome back to Investing Talk Podcast.
Glad to be here.
Today, we're focusing on Couchbase.
Couchbase. Okay.
Let's try and unpack the latest information we have, right? From, late May 2025?
That's the plan. Our mission really is to quickly get you informed on where this company stands right now.
Looking at their financials, their place in the market.
And, what the latest reports and analyst views are suggesting, we're kind of sifting through the noise for you.
And we've seen some really interesting data points. They create a clear picture, but there's also a key tension, wouldn't you say?
Oh, definitely. You see these strong growth numbers, particularly in their annual recurring revenue.
Yeah.
ARR.
Right there, it looks good.
But that's paired with the reality of continued net losses.
Which is pretty typical, I suppose, for a company investing heavily like this.
It is, especially for software as a service businesses at this stage.
Yeah.
We'll help you understand what these seemingly conflicting points mean for their business.
Okay, and this is where it gets really interesting, I think. We need to look at their core products, like Capella,
How that positions them,
who they're up against, market sentiment recently.
and what key factors are really worth watching moving forward, why they think this spending now pays off later.
Okay, let's maybe start with the numbers then. Unpack those financials first.
Sounds good. So the latest info, again, as of late May 2025, total revenue for their last fiscal year, FY25, was around $215 million.
Okay.
And if you look at the trailing 12 months, that figure was about $209 million. Q4 specifically came in at, $54.9 million.
Which was about 10% growth year over year for just that quarter.
Just about, yes. 10% for Q4.
You mentioned ARR earlier. That's the big one for software, isn't it? Annual recurring revenue.
It really is. That predictability is key. As of January 31st, 2025, their ARR hit $237.9 million.
Wow. Okay. And the growth there?
That was a solid 17% increase compared to the year before. And looking back, say, 3 to 5 years, they've pretty consistently shown double-digit ARR growth.
Driven by subscriptions, the lifeblood of these platforms.
That's it. Sticky subscription sales.
Okay, so ARR growth at 17%, that sounds, quite promising for a company this size.
It does.
But like we flagged at the start, that growth isn't coming cheap, is it? They mentioned exceeding guidance.
They did, on both revenue and, interestingly, on the bottom line losses in Q4 FY25. They lost less than expected, but
still significant losses.
that's correct. While they beat expectations, the losses are definitely still there. Trailing 12 months, net losses were around $74.65 million.
Which works out to about negative $1.45 per share, roughly?
Approximately, yes.
Yeah.
And again, this is, very common for companies in this aggressive growth mode in software.
They're choosing reinvestment, R&D, sales, marketing.
Exactly. Pouring it back in to capture market share, scale up operations. The bet is that grabbing that share now leads to a much bigger, more profitable business down the road.
So the financials really show that trade-off. Prioritize growth, get more customers, boost that recurring revenue, even if it means losses for now.
That's the story in the numbers. We don't have specific forward PE ratios right here or detailed debt figures.
Right. You'd need to dig into the SEC filings or data platforms for those balance sheet details.
Correct. The 10K from March 2025 would have that. However, there was a positive sign on the cash flow front in Q4.
Oh, what was that?
They actually hit their highest quarterly free cash flow during that period.
Free cash flow. So the cash left after operating expenses and capital spending.
Basically, yes. Now, it was still negative for the full year, but achieving a positive quarter is a good sign. It suggests improving cash generation as they grow.
Some operational efficiency may be starting to kick in.
Potentially.
Yeah.
It's a critical step towards eventual profitability. And as expected, they don't seem to pay dividends. All cash goes back into the business.
Okay, so the financial picture is this real balance, isn't it? Strong, consistent ARR growth, maybe early hints of better cash flow.
Set against significant net losses because of that heavy investment.
That tension is definitely central. Okay, let's shift gears. Talk about the business itself, their market position. What gives Couchbase its edge? What are they actually investing all that money in?
Well, what's interesting is their focus and their architecture. Couchbase positions itself as a developer-focused NoSQL database platform.
NoSQL, maybe a quick reminder for listeners, not the traditional tables.
Right. Traditional databases use SQL, structured query language, very rigid tables like spreadsheets. NoSQL means not only SQL, much more flexible, handles diverse data types, documents, key value pairs, graphs.
Better for modern apps that change fast or use less structured data.
Precisely. And Couchbase aims its platform right at critical, demanding applications. And importantly, they're highlighting relevance for AI workloads.
Ah, optimized for AI. That sounds like a very timely differentiator. How does that actually work? What makes it good for AI?
It comes down to performance and flexibility, really, designed for those specific use cases. The sources point out Couchbase's architecture is built for high throughput and low latency.
Getting data in and out fast.
Very fast. Crucial for real-time apps and the kind of data models AI relies on. Plus, flexible data structures for machine learning.
And their main product here is Capella.
Yes, Capella is their key offering. It's their database as a service, or DBasis. Think of it like MongoDB Atlas or Amazon DynamoDB.
So instead of installing and managing it yourself,
You use Couchbase as a fully managed service in the cloud. Much easier for companies to adopt.
okay, so Capella is the cloud service, easier adoption, built with AI needs in mind. How does that stack up against competitors? You mentioned MongoDB, Amazon DynamoDB.
They're definitely seen as an innovator, maybe a challenger, in this fast-growing NoSQL and cloud database market.
MongoDB is arguably the leader in NoSQL, right? And Amazon's DynamoDB is huge within AWS.
Absolutely. But Couchbase is carving out its niche. Its strengths seem to lie in specific hybrid cloud capabilities.
Meaning running across different clouds in your own data center.
Yes, seamless deployment and management across multiple public clouds, AWS, Azure, Google Cloud, and on-premise. Plus that focus on high performance, real-time, and AI support.
So analysts see them as a challenger using modern architecture, especially where hybrid or specific performance matters.
That seems to be the consensus view, yes.
Is that hybrid cloud capability really a big deal? Couldn't customers sort of rig something similar with other tools?
Well, the seamless part is what they emphasize. Couchbase claims its architecture handles distribution and synchronization across these different environments more natively.
Built for it from the ground up.
That's the idea. For companies that can't or won't go all in on one public cloud, maybe regulations, legacy systems, strategic choice, having one database that works consistently everywhere is a big plus.
Reduces complexity, operational headaches.
Compared to stitching different things together, yes.
Yeah.
That's a key part of their pitch, especially to larger enterprises.
Makes sense. And thinking bigger picture, what industry trends are really playing in their favor here? Multi-cloud, real-time data.
Those are the major tailwinds, and they align almost perfectly with Couchbase's focus. First, like you said, growing enterprise use of multi-cloud. Companies want flexibility.
Avoiding vendor lock-in.
Right. Second, the huge demand for real-time data processing. Businesses need instant insights now more than ever.
Customer experience, operations, everything.
Everything. And third, maybe most relevant given their AI focus, is the explosion in AI and machine learning integration. That often needs fast, flexible access to big data sets.
And Couchbase is saying, hey, our platform, especially Capella, is built for these trends.
That's exactly their message. These trends are drivers for Capella adoption.
But okay, where there are tailwinds, there are usually risks too, especially in a space this hot. What are the big ones for Couchbase?
Competition is the main one, without a doubt. The hyperscalers, Amazon, Microsoft, Google, have massive cloud ecosystems with deeply integrated database services.
They can bundle things, maybe offer lower prices, huge sales reach.
All of that. And MongoDB, as we said, is a very strong direct competitor in NoSQL. Plus, you always have the evolving regulations around data privacy and security globally.
So winning deals means Couchbase has to really prove its unique value, that seamless hybrid cloud, the AI performance edge.
They have to articulate and demonstrate that differentiated value very clearly.
Got it. Okay, quick touch on leadership. CEO Matt Cain is also chair and president. Any sense of stability there?
The sources suggest leadership continuity is stable. Matt Cain sounded confident publicly around the FY25 results.
No red flags mentioned in the material we looked at.
Not specifically about the broader team structure or insider trading, no.
Yeah.
For a deep dive on the whole team, you'd look at their exec bios or SEC filings. But the public messaging seems steady.
Okay. So recapping, financial story is growth funded by investment, that core tension. Business story is Capella, hybrid cloud, AI focus as differentiators.
In a competitive market, but riding some strong industry waves.
Right. So how has the market reacted to all this? Stock movement, sentiment.
Well, the stock's definitely shown some volatility over the past year. Not unusual for a growth tech name. It ranged from a low around, $12.78 to a high near $26.67.
And more recently, late May.
Trading between $18 and $19 per share. That puts its market cap just under $1 billion. around $997 million.
Any recent momentum?
It saw a small gain, about 2%,
Mm-hmm.
in the couple of weeks before May 27th. So some recent positive movement.
And what about the analysts covering Couchbase? Are they buying the growth story despite the current losses?
The consensus seems cautiously optimistic. The general rating is leaning towards a buy.
With a price target.
Average target is somewhere near $21. That suggests analysts see maybe 14% upside from those recent $18, $19 levels.
Any specific analyst calls mentioned?
One source mentions Stock Invest upgrading them to a buy candidate based on technical chart signals, forecasting potentially more significant upside, maybe over 20% in 3 months, if those technical trends continued.
Okay, so analysts are generally positive. That seems to fit with the company beating expectations recently. That usually helps investor confidence.
It does. And we also saw mentions of institutional activity, like Deutsche Bank increasing their holdings late last year. That suggests some larger investors are also finding the story compelling at these prices.
So it feels like the market, or at least parts of it, are looking at the growth, the Capella strategy, the AI angle.
And seem willing to look past the current losses, betting on future gains.
Okay, so for listeners tracking this, what are the key things to watch in the near term? What validates that positive view?
The absolute number one thing is the upcoming earnings report.
Right, there was a bit of confusion on the date, maybe early June?
Possibly June 3rd, based on one source, for their Q1 FY26 results. You definitely want to double-check the exact date on their investor relations site. But that next report is critical.
Why so critical? What are we looking for?
It's the freshest data. Is that strong ARR growth continuing? Is the trend towards improving free cash flow holding up? Plus, you'll get updated commentary from management, their outlook.
Giving a clearer picture of that path to profitability everyone's watching.
Exactly.
Beyond the headline earnings numbers, anything else? Specific products or market moves?
Definitely keep an eye on Capella adoption. That DBS platform is central to their strategy. Strong uptake there should boost ARR and could improve margins over time as it scales.
Makes sense. What else?
Also, they launched Edge capabilities back in March 2025. That's about moving data processing closer to where data is generated. Think mobile devices, IoT sensors.
Part of that distributed architecture trend.
Right. So watching customer adoption and any revenue contribution from that new Edge offering will be important too.
But the risks haven't gone away, obviously.
Not at all. The pressure for profitability remains. If ARR growth slows down, that would challenge the current investment strategy.
And the broader economy. Macro uncertainty.
That could still impact IT spending, slow down big database decisions, or Capella adoption. So how they navigate competition and any economic headwinds is really key.
Okay, so let's try and wrap this up. Summing up our look at Couchbase based on the latest info.
I think the core story we've unpacked is really one of a high-growth software company. They're clearly trying to leverage major industry trends, multi-cloud, hybrid cloud, real-time data.
And especially that demand for platforms suited for AI workloads.
Right, and you see that reflected in their solid ARR growth, around 17% year over year. And those early signs of improving free cash flow suggest some operational gains.
But, and it's a big but, common for companies at this stage that growth requires heavy spending. Hence the ongoing net losses, about $74 million over the last 12 months.
It's that classic investment phase trade-off. Spend big now to build scale and a defensible position for hopefully much greater profitability later.
And market sentiment seems cautiously positive. Stock around $18, $19, analysts leaning towards buy, with targets suggesting some upside.
It seems investors and analysts are banking on that momentum continuing, driven by Capella, their hybrid niche, the AI angle, and hoping they can execute against giants like MongoDB and Amazon.
And the very next catalyst is that upcoming earnings report, probably early June. That's the next big checkpoint for everyone.
It really is. See if the growth continues, how Capella's doing, and crucially, how that path to profitability looks. Are they balancing investment and efficiency effectively?
So maybe a final thought for you listening. As you process this information on Couchbase, how do you weigh that balance, the strong top-line growth and strategic positioning versus those ongoing net losses?
That's the crucial question. What specific metrics, beyond just revenue or ARR, would you need to see in their future reports to feel comfortable? Maybe gross margins improving, sales and marketing spend efficiency, customer acquisition costs.
Something to definitely mull over.
Mm-hmm.
Well, we hope this look at the latest on Couchbase has been valuable.
We hope so, too.
If you found this helpful, please do subscribe to the podcast, like this episode, and maybe leave a comment with your thoughts on Couchbase or any questions you have.
Your engagement really helps us figure out what topics you want us to cover next. Thanks for tuning in.